We continue with our discussion on FRA Unit 2, and in this particular video we're going to use a couple of examples. We're going to look at a problem and try and solve that problem by creating the journal, by creating the ledger, and then also creating the trial balance around it. So effectively we're going to try and solve these three portions in the entire equation: journal, ledger, and trial balance, right? So without much ado, let's get into the actual problem and try and gauge what the statements are. Let's say we have to journalize the following transactions for a company, create ledgers, accounts, and the trial balance, right? Because journals are created in a chronological order, we have a set of 6 transactions starting 3rd of May going on till 8th of May, any particular year. And the transactions involve a few series of works as the company goes towards building its business. So the company starts the business with a cash of rupees 5 lakh put in as capital by a person A. Purchased machinery on the next day worth rupees 4 lakhs with the cash received in the step 1. Next day purchased goods worth 20,000 from supplier ABC on credit, and the same day purchased goods worth 20,000 from supplier DEF on cash. So half of the supplies were purchased on credit, half of them on cash. A couple of days later, on the 7th of May, sold goods worth 60,000 to client GHI on cash, and then made a payment of 20,000 to supplier ABC. This supplier, who had given the money earlier, a payment of 20,000 was made to, given the goods earlier, the payment of 20,000 was made to the supplier, right? Now, the general format of a journal would basically appear something like this, right? So we'll put in whatever the date is. Certain account gets debited, another account gets credited. We will also try and put in the account type, which is real, nominal, or personal. And then based on that, put the debit and credit on this side, right? So put the debit and credit on this side based on that. So that's what we're going to do, and for this purpose it might make sense for us to use an Excel file where we can build in all this data, right? And then we can build the ledger accounts, individual accounts of cash, machinery, etc. If we look at this, we can automatically say what are going to be the various accounts. There is going to be a cash account, there is going to be a capital account. Capital account is for person A, capital account for person A. And then there's going to be a machinery account, and there is going to be a purchase account. What else? We have a supplier ABC account, supplier DEF account, client GHI account, and yeah, and a sales account. Right, so broadly these are the kind of accounts we will have when we try and create the ledgers. We don't necessarily need to create everything under the sun on the ledger. Most important ledgers would be those where a lot of transactions are happening. But anyway, let's start with the journalizing process. Let's create the journal for each of these transactions starting 3rd May, first transaction. So we go to this file where we have the date and the particulars put in. So the first date is 3rd May, and the particulars are that the company has basically purchased, started the business with cash of 5 lakh put in as capital by person A, right? So what is going to debit? We're going to put in cash account debit. Why debit? Because cash is a real account, right? And debit what comes in basically in this case, right? To capital account person A, or person A capital account, we can name it anything. That's the second account that comes in. And remember, this is a personal account. In personal account, you have to credit the giver, right? You have to credit the giver and debit what comes in. Basically, asset comes in here. So we have to debit 5 lakh rupees here, and we have to credit 5 lakh rupees here. Get the point? Cash account is an asset, Asset going up is debit. Asset is also a real account, so what comes in has to be debited. Capital account is a personal account. Personal account, the giver gets credited, right? That's what happens here. Transaction 2, purchased machinery worth 4 lakh with cash received earlier. So on 4th of May, machinery account debit. Why? This is also a real account. To cash account credit. Why? This is also a real account. What comes in? Machine comes in. What goes out? Cash goes out. So that's basically why we put cash in credit and machinery in debit, right? Let's move ahead. Let's move to the next transaction. We have 5th May, purchased goods worth 20,000 from supplier ABC on credit, and 5th May, purchased goods worth 20,000 from supplier DEF on cash, right? So 5th of May and 5th of May, there'll be two transactions. Purchase account. Purchase account is again a real account. So purchase account gets debited, right? Purchase account gets debited. And in one of the transactions, we are doing purchase account debit to cash account credit. And this is a real account and this is a real account, and 20,000 comes in and 20,000 goes out, right? In the second transaction, we are saying purchase account debit. That's a real account once again, 20,000. But now someone is giving us this money, right? 20,000, sorry. Someone is giving us this money to supplier ABC account, and this is a personal account. Credit the giver. Once again, this guy is a giver, credit the giver, right? 7th of May, the next transaction happens, is sold goods worth 60,000 on cash, right? So you basically sold whatever the client name is, you sold goods on cash. So 60,000. Now, when you sell goods for cash, cash account gets debit, real. Why? Because you receive 60,000. And to sales account, now here there is a small interesting point. Sales account can be treated both as a real account, in which case what goes out, the goods that are there go out, those get credited. It can also be treated as nominal accounts where all expenses are debited and all sales and incomes are credited. So we're going to put it as nominal. 60,000 comes here. That's then this can also be demarcated into two steps, which is it could be cash account debit to customer GHI account credit, and that would have been a personal this thing, and then customer GHI credit debit to the sales account, right? So we could do that as well in two steps, but right now we're going to use only one step and put it like this, right? So that's this, and on the 8th of May, you have made a payment of 20,000 to the supplier. So supplier ABC account debit. That's, remember, a personal account. He's a receiver in this case, 20,000 to cash account. Cash is a real account, 20,000 goes out. Correct? That's your entire journal entries for these transactions, right? Now we can go about making the ledger account entries. So some of the entries are straightforward. So for example, sales account is, you will see a straight 60,000 credit that comes here, and I'm going to put credit here and debit here. Similarly, machinery account is a straight 40,000 debit, right? But if you look at something like the cash account, that's going to have a lot of debit and credit. So initially the cash account starts with a debit here. I'm going to color this so that we know we've used that. So cash account gets debited 5 lakh on the 3rd of May. Then 4th of May, same cash account gets credited for 4 lakh. So we have 4 lakh that comes here in terms of the credit here. Then we go ahead and look at 5th May cash account credit. That's a 20,000 credit again here, and that's 5 May. And then we go further and we find cash account debited for 60,000 here. That's on 7th May when you sold something worth 60,000. And on 8th May, it was again credited for 20,000 which you paid to the supplier. So cash account balance is going to be equal to the sum of all the debits minus the sum of all the credits. So we find 120 of debit in the cash account. Then we have purchases account, and that purchases account gives us about a debit of 40,000, right? So purchases account gives a debit of 40,000. Supplier ABC account has matched, 20 came in, 20 goes out, so that has kind of matched to 0, so that will remain 0, right? Now let's try and and there is also a person A capital account, and that's 5 lakh rupees debit, right? Now when we create a trial balance out of it, a trial balance is going to have all these account headers, and it will have a debit and a credit, and the debit should match the credits, right? So let's put cash, let's put person A capital, let's put machinery, let's put purchases, let's put sales. Yep, so let's put in the credit entries first. We know person A capital 5 lakh is credit and sales 60,000 is credit, right? So that's equal to the sum of these four, these five. Cash is, note the cash account balance is a debit balance of 1,20,000. Then you have 4 lakhs here, and then you have purchases worth 40,000. And if I do a copy paste formula, you will find that the trial balances both the debit and credits are equal, and we can basically delineate it in this way so that the total debits equal the total credits in this case. And that's basically how we go about journalizing a certain set of transactions, creating accounts out of that, ledger accounts. Ledger accounts creation here was a simpler process because most of them had single entries with the exception of cash. And then the trial balance where basically the debits and credits kind of match with each other, right? So that's broadly the contour of how do we go about working on any such transaction, creating journals, ledgers, and trial balances, right? We'll try a few more examples in subsequent videos, and I would urge that you also try some of these examples on your own. The trick is to basically understand what is getting debited and credited, and it will come automatically if you can classify what account comes, what kind of account each of these accounts is. Thank you.